Vinay Sharma, Equity Fund Manager at Nippon India Mutual Fund, joins in to discuss just that. Vinay, good to have you on board. Let's begin with your outlook in terms of PSU Banks, whether or not you see much more room for expansion and growth. Do you think the multiples will ever get close to that of the private peers?
Well, from a fundamental point of view, it definitely seems that the performance of PSU banks is improving over the past few quarters, and it looks like it will continue to improve over the next few quarters. Primarily because if you look at the last 6-7 years, PSU banks have faced the brunt of the worst, one of the worst corporate banking crises that India has ever seen. And now it seems like we are surely at the fag end of that corporate banking asset quality crisis. And most of the PSU banks today are also sitting at decent provisions on both those corporate NPLs, as well as they've done some decent provisioning on their estimates of COVID-related stress as well. If you look at valuations today compared to what they have been over the past, a long cycle, like past 10-15 years, valuations still have reasonable upside if fundamentals really improve from here on, which is a decent probability, as I said earlier. So therefore, we remain quite sanguine on PSU banking space as a whole, but within that space, we like the larger PSU banks more than the medium-sized ones, primarily because of two reasons. One, we believe larger PSU banks have shown much more resilience in terms of both market share and in terms of controlling the stress that we have seen over the past few years. Second, we believe when it comes to equity dilution and gaining access to capital, the larger PSU banks are considered more favorably by the market, and the chances of equity dilution are quite low there compared to the medium-sized ones. So we would like to differentiate between the larger and the medium-sized ones, but overall on the space, we believe, there is significant re-rating potential still remaining in that space.
Okay, fair enough. And when it comes to the asset quality, what's the view sector-wise, including the pain point regions, particularly West Bengal, Assam, banks like Bandhan Bank as well are seeing a very serious problem over there. So what are you making of the overall asset quality concerns? Do you see this abating? Are there any particular banks that you believe that this will remain a worry for some time to come?
So rather than talking about banks, we believe we have to segregate asset quality in terms of the subsegments that these banks lend.
Unfortunately, we seem to have snapped that line with Vinay. Vinay, can you hear me correctly? And can we come right back to you? Okay, we'll connect with him in just moments from now. But yeah, talking about the overall asset quality as well, and just the general view from Nippon India Mutual Fund is that there is an improvement in the performance of the PSU banks in the last many quarters, and that we are now coming to the end of the corporate NPAs. There is still a lot of potential in PSU banks. Apologies for that, Vinay. We seem to have lost your audio. Go right ahead with what you were talking about when it comes to asset quality.
Can you hear me now?
Yes, we can. Go ahead, Vinay.
Yeah. So I was saying we have to segregate asset quality in terms of segments. The segments where we believe it's not very clear whether we have passed the hump or not are probably the SME segment, MSME and SME segment. Some segments of retail, primarily the urban poor and retail related to sectors like hospitality, travel, stuff like that, which have been severely impacted due to the COVID pandemic. But in our opinion, banks really don't lend too much to these segments. And even in the SME and MSME segment, because of the government support that has been provided in terms of the credit guarantee schemes, it seems that the problem would be much smaller than what was anticipated a few months or a few quarters earlier when the pandemic actually started. So overall, on the asset quality, from an asset quality point of view, things seems to be improving and improving quite rapidly. One of the segments where we were earlier quite worried, which was the real estate, we have seen housing data improve very significantly over the past few months. And if that continues, that would be good news for a lot of banks as well as NBFCs, because mortgage is one of the prime lending area in Indian banking industry, and mortgage is primarily the collateral for almost all assets as well. So therefore, things seems to be improving there as well. As you said earlier, MFI is a area of concern, and particularly in some states, it seems like there is some stress emerging. But again, that is not a big part of the Indian banking system. So from an overall systemic point of view, it really doesn't concern us that much.
Okay. So do you see room for multiple expansion when it comes to PSU banks? Do you see them ever reaching the PE multiples that we see on the private players?
No, I guess there would certainly be a differential between the private banks and the PSU bank multiples, primarily because if you look at the return ratios, they are quite different. The ROEs of private banks are upwards of double digits, and close to, for some banks, it's close to 18-20% as well, whereas the PSU banking space has not shown return ratios for the past few years, and it is just the hope that normalization of profitability will resume now, and provisions will go down, and ROEs will come back to what it used to be in the 5-6 years back. But still, because private banks have been gaining market share across time periods, they are far ahead in terms of technology, in terms of the management bandwidth that they have shown over the past few years in managing the macroeconomic situation. So I don't think multiples will ever converge between private banks and PSU banks, but just looking at PSU bank history only and comparing them just to their average valuations when times have been much better than what they have been over the past 3-4 years, we believe there could be scope for re-rating when the normalization of profitability happens in PSU banking space.
Fair enough, and I can't help but ask about SBI. It's been a phenomenal rally that we've seen really play out in the stock price, and that's largely owing to a very strong set of numbers, the kind of management commentary as well that we've got. But when it comes to the valuation picture, do you think that SBI is grossly undervalued?
Well, as you know, we can't really comment on individual stocks as a company guideline. So I would not like to comment on individual names here. But as I said earlier, if you look at the larger PSU banks, it seems they have managed the COVID crisis much better than what was anticipated earlier. These banks really do not are not finding it difficult to access capital as well, right? Because of government support, as well as now market is also willing to look at them when it comes to equity raising. So therefore, any future equity raisings would not be capital dilutive or would not be dilutive for the minority shareholders. It seems a normalization of profitability is now resuming, and FY 22-23 numbers will look much better than what we have seen over the past few years, primarily because provisioning cost is going down. And these banks are sitting on a lot of liquidity today because credit demand was much lesser than what deposit growth was over the past few quarters. When credit demand comes back into the system, we will see operating leverage kicking in some of these banks. So therefore, in the context of this macroeconomic scenario where it seems things are really improving quite rapidly for some of these banks, we believe valuations still have a lot of scope for re-ratings, particularly if you look at the context of market today. Markets are almost at all-time high. Valuations have reached very close to their all-time highs, whereas these banks are nowhere close to what their peak valuations have been in the past.
Okay, fair enough. And, how do you see these PSU banks in terms of opportunity to raise capital at these low valuations as the recap is low? What kind of an alternative do you see apart from AT1 for them to raise large capital to try and tap the credit opportunity and continue to provide for stress?
Well, we believe if the situation improves as it has been over the past few quarters, and if profitability normalizes to what the potential of these banks is, then capital would not be such a big issue as it has been over the past few years. If profitability normalizes and return ratios improve from here on, market would be willing to look at them and they should be able to access capital from market itself. Obviously, there is government support, and in the budget, it has been already announced that there would be 20,000 crores provision for PSU banking capital requirement. So overall, it's a matter of time. We believe once market sees the profitability in their sees the improvement in their profitability numbers, it should not be a big issue now for them to raise capital and. Therefore, to that extent, we don't think this is a major worry for them now.
All right. Thanks so much for joining us this morning, Vinay, and taking us through your views in great detail there.
Thank you. Thank you for having me.